Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q4 2020. My name's Gary Stockton. I'll be starting in just a few moments. If you'd like to follow along, we've dropped a PDF of the slides in the handouts area. We'll also include a link to those slides in our follow-up, so no worries on that. You'll have that after the webinar, probably tomorrow. During today's webinar, we're going to be discussing key findings in the Experian Moody's Analytics Main Street report for Q4 2020. The review will be presented in 3 segments. Presenting from Experian will be Brody Oldham, Senior Director of Analytics Consultancy. Presenting from Moody's will be Christian Deritis, Assistant Chief Economist. And economist Derek Grunfelder-McCrank will be presenting also from Moody's. If you have questions, please engage with the applet. We look forward to receiving your questions throughout, and we'll try and leave some time at the end. So please raise your hands. I get those questions answered. We've got the experts, a panel of experts here for the next 45, 50 minutes. And now I'd like to turn things over to Christian Deritis from Moody's Analytics to start today's program. Christian.
Wonderful. Thank you, Gary, and welcome everyone to our quarterly outlook here for small businesses and small business credit. And I'm going to be kicking things off with a macroeconomic outlook tailored towards small businesses, as I usually do. And what can I say, but what a difference a quarter makes, right? During our last session back in December, you'll recall there was quite a bit of uncertainty in the economy. We had some good news from vaccines, right? We had just received the announcements that the vaccines had been approved and were starting to be rolled out. We were in the middle of the election season, though, still, right? Still lots of unanswered questions about the Senate and trying to make some predictions of what the House what those runoff races would look like in Georgia. We certainly got some clarity now with the Democrats taking both seats, and that then having an impact on our stimulus forecast. At that time, we were also wondering what the stimulus would look like, not only the stimulus that was eventually passed in December, but then this latest $1.9 trillion package that was recently passed, signed into law by President Biden. So a lot has happened certainly over the last quarter, and we continue to have quite a bit of good news, right? Vaccination programs in the U.S. are overcoming their slow start and really taking off now, and we're on good solid footing to hopefully have herd immunity sometime this summer. So that's certainly the first and foremost important item when it comes to the economic outlook. Stimulus, as I mentioned, has been passed, and that's certainly going to lend some support as well. As we look at the economy, though, where I like to start is an analysis of the labor market. Here we go. And if we look at monthly job gains, we can see some positive news here as well. Last month, we added 379,000 net jobs to the economy, which certainly is great. We welcome the positive, and it's certainly up from what we did in January and the job losses we actually experienced back in December. Good news, certainly. The outlook does call for continuing increases in jobs as we reopen, and certainly as demand increases for goods and services, we should see these job gains. However, we of course need to recognize that we still have quite a bit of hole to fill when it comes to jobs. We are still about nearly 10 million job losses relative to where we have about 10 million job losses relative to what we had last January. So still lots of room to run here, right? Even at a run rate of 400,000 jobs, which would be fantastic if we were able to maintain that type of volume for an extended period of time, it's still going to be quite a while before we recover all the jobs that we lost, plus all the additional jobs. Every year we need close to 1 to 1.2 million jobs just to keep up with population growth. And so there is quite a substantial hole here that we continue to need to fill. Do expect to see some accelerated job growth in the short term, though. Again, as we have some reopenings occurring, consumers are feeling more confident, we should see some additional job gains. In particular, we should see those gains in the areas where job losses were largest, in the leisure hospitality industry in particular. And you can see on the chart here, I'm showing you the percent change in employment relative to our last data point for February. And you're looking at the change from a month ago, a quarter ago, and a year ago. So it gives you a sense of, for each of these sectors in the economy, how the job losses and gains are playing out. So leisure hospitality at the bottom of the chart, here again, you can see we lost the most jobs in this sector, about 20% or more of that industry relative to a year ago. We had continued to make see some job losses over the last quarter, right? So that weakness in December did continue to show up in the leisure hospitality industry, but then most recently in February, we started to see a bounce back here. And so that gives us some optimism when it comes to the future. Very important sector for small businesses. A lot of small restaurants, small hotels, bars, whatnot are in this category. So clearly one we want to watch when it comes to looking at small businesses overall. But you have small businesses in every industry, and you can see across the board some positive news. But again, we have to be a little bit guarded in terms of our optimism. No industry, no sector, as you can see here, has fully recovered all the job losses over the last year. Even financial activities, which lost the fewest, is still in negative territory. It's slowly coming back, but again, we're not fully back to where we need to be. But we're making steady progress. Professional services saw a nice bump up last month, so that's also a positive here. And you do have retail trade, again, an important sector when it comes to small business, showing some job gains here as well. So overall, very good news, I would say. But our desire, of course, is to have more and faster growth. And I do believe that this latest stimulus plan is going to provide some of that, at least short-term bounce that we hope for. As we start to look forward and consider where small businesses might be headed, it's useful to take a gauge of small business sentiment. So we look at surveys of small business owners to understand what they're thinking, how they're feeling about the current state of the economy and future prospects. Those feelings, that outlook is going to really determine whether or not they're going to be willing to hire and expand their operations or still remain quite guarded when it comes to any future investment. So it gives us a good sense, particularly at a turning point like this, what direction the economy might take in general, and then for small businesses in particular. Looking at the Small Business Optimism Index put out by the NFIB in the slide here, and in particular that blue line is showing you that the optimism is still not overly enthusiastic, I would say. Right? You can see certainly off the bottom that we had last year at the height of the COVID-19 back in March, April. But not all that different. It's a bit higher than that bottom, but it's lower than what we had just a few months or quarters ago. One thing to note when you look at this index is that it is highly correlated with election cycles. This is something that's well known, and it's also highly correlated with Republicans winning those election cycles, right? So if you look back in 2016, for example, you saw the sudden jump in small business optimism as Trump was elected. A lot of small business owners are Republicans. They do appreciate low taxes and low regulation. So you do see these correlations if you go back to previous election cycles, and you see that similar pattern play out a bit here as well. At the end of 2020, you did see this dip as President Biden was elected. Now, so take that with a grain of salt when it comes to understanding and interpreting that index. This is a feeling, if you will. It may not actually represent the true investment patterns of small businesses. What is also interesting, though, is the uncertainty index that the NFIB produces, right? So basically assessing how certain the small business owners are about the future. So it's one thing to be optimistic, pessimistic. It's another thing to be certain or uncertain. We know uncertainty is certainly a drag on business activity. It causes business owners to really freeze in place. And so the good news here is that we do see that uncertainty is actually falling here, and that is certainly a positive when we think about the future here as well. So small business owners may still be a bit guarded, uncertain about the future, or a little bit pessimistic about the future, and really seeing sales ramp up, but they're not as uncertain as they were previously, and certainly that's a positive as well. Now, digging a little bit deeper into the survey results from the NFIB. There are a series of interesting questions that are asked in terms of whether or not small business owners plan to invest, raise prices, do additional hiring, what their expectations are for sales going forward. So there's a richness of the data that I think is actually perhaps more telling when it comes to understanding the future path of the economy versus just that general optimism type of question. And so when we look at the results of the survey compared to compared with the last year, you can see a couple of interesting trends. You do see that small business owners are planning to invest, right? So they do see opportunities here, and they are planning some capital expenditures over the next 3 to 6 months. So that's certainly a positive. But they also are indicating that there is some difficulty in hiring, right? That purple line at the top indicates that a number of small businesses continue to express difficulty in filling certain job positions. And what's interesting about this series is that although it did dip during the COVID crisis back in March, April, May of last year, it really never fell dramatically, or certainly didn't fall as dramatically as the other questions. So hiring quality people is a perpetual challenge for small business owners. It looks like it is getting even harder today. And I attribute that largely just to the competition with larger firms, right? So you have larger companies. If you're in retail, right, you're competing with a Walmart, a Target, and Amazon, right? There are other options that workers have, and so that certainly makes it difficult for the small business owner to hire high quality folks. Another interesting trend here is the plans to raise prices question, right? So this is helpful as we're trying to tease out whether or not we can expect some inflation. And this Bordeaux line, the second line in the slide here, indicates that a majority of small business owners are expecting to see some additional price increases in the future. So it does speak to the price pressures that we see on certain inputs. Tighter labor market is also going to lead to some wage pressure going forward, and that is going to translate to some higher prices, it would appear, based on this particular survey. Last point to make is that, again, there is some residual pessimism here around expectations for real, that is after inflation, sales volume to be higher in 6 months. That's actually still a negative territory. So there is some guarded pessimism still out there today, or as of the last data point from February. So that might feed into some of that optimism, or that lack of optimism that we saw in the previous slide. Some other encouraging data that we see is that the desire to be an entrepreneur, though, to open your own business, is still very high. The number of business applications that are being made remains at a record high. You can see that from the blue line here. It's highly seasonal. You can see that pattern here, but even if you abstract from that, you can see that we're at all-time highs on a seasonally adjusted basis. So you do have, right, close to 10 million folks who have been laid off, fewer jobs out there, but at the same time, you do see folks looking for opportunity and sensing that there is going to be opportunity as the economy opens up, and they're looking for their chance to open a business and capitalize on those opportunities going forward. One grain of salt here, we always have a grain of salt as economists, right? If you look at another series that is connected or collected around entrepreneurship, there's this high propensity application version of this series. This is perhaps a better measure of how many businesses will actually be started and lead to job growth, lead to hiring, right? There's a smaller share, plenty of people who apply for a business, they may have it as a backup plan if other things don't work out, but they never follow through on that business. Looking at the higher propensity applications does indicate an increase in entrepreneurship and job or business starts going forward, but a little bit more modest than what the overall application index would suggest. So again, there's optimism out there. It is increasing, but it's not overly optimistic, I would say, at this point, at least not on the small business front. Now, as we think about the future outlook for the economy overall, the biggest factor that we see right now, after having controlled and assuming we do continue to control the pandemic, is the $1.9 trillion stimulus package that was passed. This is going to lead to a large near-term injection of capital onto household balance sheets through both stimulus checks, which have already started to go out and be delivered to a number of households, and then the extension and enhancement of unemployment insurance benefits. So you can see in the chart here, I'm showing you personal income relative to 2019 Q4, so last data point prior to COVID. And you can see that on an annualized basis, this package is now going to actually dwarf what we experienced during the CARES Act, right? So it's a substantial amount of funds that is going to enter into household balance sheets. Part of that certainly will be used to pay down debt, hopefully increase some savings, but a substantial portion of this is expected to make its way out into the economy as well. This particular package is more highly targeted towards lower income unemployed workers, people who tend to spend the stimulus checks that they receive. So that should lead to faster growth during the rest of the year. And we're actually anticipating a 6% GDP growth rate for 2021 as a result, and something similar for 2022 as well. So there's a long tail to this recovery here. And that's certainly good news for the economy overall, and then for small businesses in particular. One last point before I turn it over to my colleagues here is just I would encourage everyone just to keep an eye on what's going on with productivity, right? So for short term, say the next year or two, things do look quite bright in terms of the overall economic growth story, continuing job growth as well. That's going to be very helpful for households as well as small businesses. What is going to be a determining factor in terms of our longer term growth and sustainability of this recovery is what happens to labor productivity, right? So output per hour is a common measure. And what you can see on the slide here is some good news. Recently, during the last year, we did have an increase or surge, if you will, in productivity growth. That's certainly beneficial, but it's also not uncommon during recessions, right? During recessions, you will have businesses cutting costs, looking to do more with less, right? To continue to deliver revenue, control their costs at the same time. And so you did get that productivity surge. Now the big question on everyone's mind is this a temporary phenomenon, much as what we had during the great financial crisis back in 2009, 2010, which we had a big productivity surge, but then we lost it almost immediately. Or is this time truly different because of the nature of this crisis and the fact that we are leveraging more technology? We have work from anywhere capabilities, right? So we can maybe more efficiently allocate jobs to the places where people live. We are using cloud computing all across the board, right? So we have all this technology, including video conferencing, that might actually lead to real productivity growth. And if that is the case, if at least part of this productivity growth can be sustained, that certainly points to a more robust recovery going forward, and we could continue to grow even at a faster pace of growth post-pandemic here than we had during a very positive period prior to the pandemic. So overall, it's a fairly optimistic picture here. However, of course, we want to be aware of some of the key risks to the outlook. First and foremost is control of the pandemic itself. With that, I'm going to stop. I look forward to your questions, and I'll pass the session over to Derek.
All right, thank you, Chris. Let's see if I can move the slides. Gary, can you make sure that I have permission to move the slides?
Yeah, just
there we go.
The slide there.
Excellent. So hello, everyone. I'm Derek McCrank. I'm an economist at Moody's Analytics, and I'll start this webinar the way that I always like to start our webinars, saying thank you to our partners at Experian for letting us work with them on some of their data that they have for small business credit. The data set encompasses about 8 million small businesses, so we're able to really dig down into the minutia of what's happening with small businesses on a quarterly basis and what's going on with the credit outlook for those small businesses. And with that, I will jump into my deck. And apologies, I typically have a bit of a lag Gary, has the slide moved for you?
No, it hasn't. I can move it on. First one.
Excellent, thank you.
Ways. There you go.
Yeah, there's always something. All right, so small businesses have returned to hiring in the fourth quarter. As you can see, small businesses have been adding to their headcounts. So for the smallest employer firms, those with 1 to 19 employees, we've seen a nice uptick in their hiring. So at the trough of COVID, we had seen that several million, about 3.5 million people had been let go from small businesses on either a temporary or permanent basis. And from Q3, that number was about 2 million. And as of Q4, small firms had added about another 200,000 people back to their payrolls. So small businesses in the 1 to 19 and 20 to 49 categories are now down about 1.8 million jobs from their pre-pandemic peak. And this corresponds with an uptick in employer sentiment that we've seen through the Moody's Analytics Global Business Survey. So as businesses are regaining their confidence, getting to refer back to something Chris said, more certain in the future as vaccines have rolled out and there appears to hopefully be an end in sight for COVID-19, at least for the most part. Small businesses have gained the confidence to resume hiring or bring people back who they had temporarily let go during COVID. On the credit performance front, we've seen a substantial improvement in small business credit from the already what looked to be a floor in small business credit delinquencies. So we had seen that throughout the last few years, small business delinquencies, moderate delinquencies, so the 31 to 90 days past due buckets had been hovering about 1.5, 1.6% and just bouncing around these levels. Well, as of the fourth quarter, we've seen that this delinquency rate is now down to 1.2%, which is an all-time low for this series and something that we might never have seen without the extraordinary stimulus measures that have come into place over the last year with COVID. So a lot of people like to talk about PPP loans, and I admit I'll be talking about them some more myself, but I'd also like to talk about something that doesn't get as much attention, which is just the forbearance options that have been put into place on existing loans. And these have really been a boon to small businesses. I'll get into that a little more in 2 slides, but the COVID relief bills have included provisions other than PPP to support small businesses, which are a large part of the reason that we have seen this significant decline in delinquency rates for small firms. But before I talk about that, I'm going to take a look at the regional distribution of delinquencies. So across the country, the story has been almost unanimous that delinquencies are declining by 20 to 30 basis points. A couple places where this isn't true are places like New England and the Plains regions. So we've seen slight upticks in the delinquency rates for these regions, primarily driven by just a couple of industries. So in the Plains region, we've seen that retailers and wholesalers have seen rising delinquency rates, even with PPP lending and other relief measures as part of COVID stimulus bills. And then in New England, we've seen a lot of weakness from small manufacturers. So they've been struggling to keep up with servicing their credit obligations. Other than these couple of industries in these 2 regions, we've seen across the board that industries and regions are seeing their performance improve for small business credit. And large part of the reason for that is, SBA loans. So we've seen also an all-time low set in the fourth quarter for charge-offs from the SBA-backed loan portfolio. As many of you are aware, I'm sure, the primary tools that the SBA used prior to the COVID pandemic were 7A and 504 loans. So in addition to PPP, which has now become a huge part of the SBA's responsibilities, they have these two loan programs where the SBA backs loans, small business loans given out by depository institutions. And what we've seen over the last year is that the SBA has been, as part of the COVID stimulus, paying for these pre-existing loans. So if a small business had taken out an SBA-backed loan prior to COVID, the SBA was willing to make 6 months of their payments throughout the pandemic on that pre-existing loan, in addition to PPP lending. So the reason that we've seen these extraordinary declines in delinquency and charge-offs has been not only that small businesses have had access to forgivable loans through the PPP programs, but their pre-existing loans were paid for 6 months by the SBA. So for 6 months, small businesses essentially didn't have to worry about going delinquent or charging off. And everything that we've been observing over the last year or so has primarily been driven by loans which were already in delinquency status or were in delinquency, and the payments have just kept them at whatever delinquency bucket they were in. So we've really seen a static environment over the last year for these SBA-backed small business loans. So it doesn't get as much attention, but that is a huge part of what we've been seeing going on for small business lending. As Chris was mentioning, taxes are increasingly on the minds of small businesses, and a lot of this has to do with politics. Since it has already been talked about, I won't go too much into it, but I did just want to point out that as of the fourth quarter, small businesses are again reporting that taxes are on their minds. So for the last 4 years, we had seen that taxes were a declining share of the worries for small businesses. But with the November elections in the fourth quarter, we've seen an uptick in the monthly survey results for people or small businesses reporting that they're worried about their taxes going up. So that'll be something to keep an eye on. And with the current administration talking about tax increases, it may create some additional uncertainty for small businesses. But again, as Chris said, with that long tail expansion, an improving economy should overpower those concerns, or at least let's hope they will, so small businesses can continue borrowing and paying back their loans, and I can keep talking to all of you every quarter. All right, so getting back to the COVID stimulus measures, and I'll just wrap up real quickly here. But consumer and industrial lending has been growing, and a large part of that has to do with PPP loans, or the majority of PPP loans being classified as C&I lending. So over the last year, even though we've seen not necessarily stronger demand for C&I lending being reported from senior credit officers, the PPP loans have stepped in to continue the growth of C&I lending and really push it up to highs that haven't been seen in quite a while. Not at all in the data that I've shown here. I just wanted a narrower window so that you could all see a little more. That it's been over a decade since we've seen this kind of growth in C&I lending. And this comes despite the disparity between the reported loosening of credit standards and the lesser demand reported by loan officers in the depository institution survey from the FDIC. And this really contrasts with what we've seen in another area of business lending that we commonly talk about, which is commercial real estate lending. So despite the PPP loans going out and pushing up C&I, because PPP loans don't really go towards the purchases of real estate. We've seen that commercial real estate lending has really dropped off and is now below 2%, which is a level that it hadn't been at since 2012, so nearly a decade, when we were at the tail end of the last economic downturn. And we don't have the disparity here that we had in C&I, where loan officers are reporting differences between demand and credit standards. We have loan officers reporting tighter credit standards alongside lower demand, which is an interesting dynamic. So even as loan officers aren't getting the same amount of interest for their product that they were before, they're still tightening credit standards, because right now, with the work from home dynamic and the people not really going out into the world as much, commercial real estate has just become a riskier option for lenders, which is why we see the results that we have over the last year, especially. So CNR lending, or CRE lending, is an area to keep our eyes on going forward, and it's something that we will be monitoring to see how the shifting dynamic in people's behavior affects this portion of small business lending going forward. And with that, I will hand things over to Brody, and see you all next quarter.
Thank you, Derek.
All right. Thanks, Derek. Well, let's see if we catch up here. There we go. As we go forward, thank you again, Derek and Chris, for partnering with us and sharing some great insights this morning. I enjoy it. I learn a little bit every time we get together, even before and after this. So it is a joy to have this in the middle of my week this week. So thank you for being part of this presentation today. We're going to talk a little bit about small business lending, digging into a few of the insights that Chris and Derek brought to us this morning. Looking at it from a small business perspective, I like to start with the small business owner themselves, because we'll see small business owners using their personal credit. A lot of you already know this. As they create a new business and begin to emerge and create their persona as a business, they'll use that personal credit to build it up until they get to a point a couple years in where they begin switching into those more commercial type products, and their business really becomes a full commercial entity. So I did want to start by showing you a few of our global decisioning survey results from Experian, looking a bit at consumers as well as how the decisions being made from the stimulus by consumers is impacting small businesses. If you look at a few of the trends here, I think that there are some really good ones when we look as far as the ability of consumers to pay bills, cash flow. We talked about some of the stimulus coming in, being able to use to pay down some balances on consumer credit. You still see here that the survey results, still a good portion of US consumers are having difficulty paying bills. As Chris mentioned, a lot of this newest stimulus package that's coming out, this 1.9 trillion, is focused on those segments of the population that will be able to spend that and be able to pay some bills, catch up a bit. That's really the intent of this stimulus package that's being approved and pushed out at this point. So that will help some of these trends as we go forward. What you'll see also is that about 60% of US businesses are planning to manage their collections process and accounts that are in arrears, rather than turn them into charge-offs or push them into more of a derog status. They're really working on pre-treatment strategies to maintain, and that certainly is in response to some of these forbearance moratorium programs. As some of them came to an end when we got into December of this past year, we saw some pre-treatment strategies leading up to that helped consumers and even small businesses to catch up a bit or create payment plans so that they didn't continue in with as much debt load and as much payment pressure as they went forward, so they could really look to keep their business resilient as they went forward. You'll see as stimulus packages begin to expire, and we're seeing some of that pushed out even into May of this year potentially. You'll see where consumers are going to look for some additional support, and you'll see small business loans is certainly one of those at about 23% looking for some additional support. We got some of that in December with updated PPP programs coming out. They're set to expire in March, but may be pushed to May. So we'll look for some support, certainly for consumers as we go forward into the next couple months. And again, that proposed push to expand the stimulus coverage into early or late spring, early summer. Now, as we continue, let's see if we can get this to go, looking at consumer delinquencies. Just one point I want to make here. You're going to see bank card and unsecured personal debt. We're looking at consumers here. We're looking at, in these charts, how loans that are being put into forbearance, those that are being accommodated and those that are not. So if a consumer comes and they say, I need an accommodation on my loan during this time period, others will say, I don't need an accommodation, I'm going to keep performing. What's the performance difference in those once that accommodation ends? And it is as expected. So those that are coming out of the these forbearance and loan modification programs are certainly more risky, and you can see that expansion of risk as bad rates increase, as more and more of those consumer products and those forbearance programs come to an end, certainly on consumer credit and commercial credit. We'll see those go up. Now, those consumers and small business owners that are making payments, even during a modified period, perform significantly better than those that don't make a payment at all. So it's a good thing to watch for, as you're looking at your portfolio, looking for those really legacy customers that you're going to keep, or those ones that are continuing to make payments, even if they're in a forbearance type or a loan modification period. All right. Now, the next set of data that we're going to go through is our small business, our SBCS, small business credit share. And this is information or a data set that Derek mentioned. It contains banks, credit card, leasing, utilities, telecommunications, so financial and non-financial information. Lots of transactions in here, millions coming in every month. And it really gives you a good picture of a small business. And what we do here at Experian is bring together that consumer and commercial information, so you really get a holistic view of the customer. Now, I will also talk a little bit today about non-traditional data and how that's helping some of our lenders to take a little deeper look into some of this business performance, and it will be especially helpful coming out of a pandemic time period where, as Chris mentioned a little bit earlier, some of these credit statistics have been pretty stable. Now, when we look at, I'm going to dig into a few products here. We'll look at the trends that we've seen. We'll mention a little bit on PPP and the impacts that we've seen so far. You'll continue to see that originations are down. Derek mentioned a little bit that loan officers are standing there waiting for some of these loans. I would say some of our big financial institutions have really been focused on PPP and supporting that program. That's really open to a wide range of business types and risk levels as we go forward. So that's very wide. They're really trying to get that program out to everyone, especially in the first pull. Second pull, a little tighter on those that are more in need. But you see large banks focused on that. Now, that's pretty low cost money out to small businesses, and so they are taking that in. What that does is, again, allows them a little money to pay down bills, balances. What it doesn't do is give them that significant need to look for private funding from some of our commercial lenders. And so we've seen origination volumes continue to decrease. We see the good part of this is delinquency levels, again, are not high and maintaining a pretty stable level of delinquency as we go forward. We are seeing a little bit of an uptick, and I'm going to show you that here next. But PPP has really taken some of the wind out of the origination growth market. but we'll see that pick back up. Originations will really start to tick back up as these programs expire early summer. Now, when we look at origination risk, we are seeing certainly in the fourth quarter some opening up of that risk as businesses dig a little deeper to see for the private funding segments how they can grow their portfolios even with all this PPP funding out there. So looking for those businesses that are in need of additional cash flow and being able to provide that to them. So we may see some lightening of across portfolio mixes, some lightening into a little bit more risky paper as we go forward, allowing a little bit more of that in to continue that growth pattern. When we look across different industries, certainly for installment lending, you'll see that it's pretty stable. And this is year-over-year looks at different industries. You can see that most portfolios are improving. The risk is getting better within the portfolio. Now, remember, with some of the stimulus and some of the forbearance programs that are out there, there's more chance to catch up, not be behind on payments. There's some forgiveness there, so you won't see delinquencies at high. So you'll see in most of the cases, certainly with installment types of loans, that it's stayed fairly stable. And we'll continue to see that into the next 3 to 6 months. When we look at delinquency levels, you're going to see that early stage delinquencies in the fourth quarter were picking up a bit, certainly across different regions, just a bit. They were certainly down from where they were, but we are seeing some uptick in some regions. And the Northeast has certainly recovered over the last quarter, so that's certainly a positive sign. But we see some of our southern states starting to pick up. As different events hit, we went through a bit of a challenging season in the South, and some of our industries were impacted there. And so we're seeing some of those delinquencies uptick. Now, some of the things that you'll also notice here within the delinquencies is that our 90-day delinquency has stayed fairly low. You'll see some of the early stage in the right-hand chart beginning to pick up, our 30 to 60-day, but it hasn't impacted 90. It means it's not rolling to that next step. When we talk about some of the strategies, modification programs that are out there for our lenders, you can really see it here that they are taking seriously the pre-treatment strategy and addressing some of these accounts before they roll to that higher derogatory level. Now, when we look at unsecured products like a commercial credit card, what you'll see here is again, that tightening. You'll see where it really dropped off is around the March, April timeframe. That's where those recessionary strategies were put in place. Criteria was locked down a little bit more. You see that trend of originations, very stable. Again, a lot of that stimulus money is still holding these origination levels down, keeping utilization fairly stable across the products. We're seeing a little uptick in some of the higher risk segments, but in general, very stable across this time period. And the expectation is we're going to see that in another 3 months to be about the same. Delinquencies should stay about the same until we get into early summer, when a lot of the stimulus packages will end. Then we will again see a surge in those delinquency levels. Now we look at our portfolio risk, and we evaluate across the portfolio. What we see from a commercial credit card sense is that they, again, are picking up a little bit more of that risk within the portfolio here. This is unsecured debt, so a little more risky. We're not seeing elevation in delinquencies, but we are seeing a little bit more risk and utilization in some of those higher risk buckets. And so you'll see that expanse there as far as risk levels across the portfolio. We look at, again, across industries, very stable. And this is our expectation, again, when we look out another 3 months, even possibly 6 months, that stability year over year will still be there across industries as the economy improves. We look at delinquency levels across regions. Again, we're seeing some uptick here. The expectation regionally, though, is that we're seeing it go up in the fourth quarter. It's leveling out over this first quarter a bit, and when we're seeing that stimulus injected, certainly from the new PPP program, that second pull that came out in December, we're seeing these delinquency levels taper off a bit. One of the things in commercial that card that's a little different from installment is that you'll see that the early stage delinquencies are down and even flattening out a bit. What you see is that 90-day picking up. Well, for unsecured debt, that makes a little more sense because you'll see them roll a little bit easier into that higher delinquency bucket from the 30 or 60. Those that are really getting into 60, a higher percentage of those are rolling into 90. So it's just saying once you're getting to that point, rolling on. So something that we'll be watching. Now, when we look at the performance of small businesses and we're thinking about what they're going to look like in another 3 months, we do a lot of this evaluation across the US. We're evaluating for businesses how they're changing for their core credit information, their core credit profile. We're also looking at non-traditional data, bringing that geolocation data, macro information as well. Looking at the Paycheck Protection Program data, as we spoke about a little bit earlier, a lot of our lenders are looking at that type of information, not only from an evaluation of additional cash flow into the business, which certainly helps them to pay back debt, but it also allows us to see who's still engaging in the market. We're also looking at different types of business activity data, so looking for closure information as we go forward. And Yelp and Google have been good sources for us as we've looked through the past year, as we've gone through the past year to get a quicker view into business closures. You know, in small business, it doesn't always mean, you don't always have to have delinquencies or derogatories to close a business. What we saw at the last half of 2020 is that businesses closed even though they were fairly healthy on paper. Now, what they saw was that the cash flow wasn't going to be there for them to survive in their particular market. Again, markets are very different based on geolocation and what are the surrounding businesses. But for these particular businesses that decided to go out of business, they could see that there wasn't cash flow available for them to survive the next 30 to 60, 90 days. And so they shut their doors. We saw a lot of business closures, and you'll see here on the right that our, you know, Chris also touched on this, that business optimization index really dropped off. But we're seeing it uptick in this past month, and that's good. What we saw in the last part of last year, and one of the things that we learned from the Yelp and the Google data, is that we saw a lot of those businesses that shut down stayed closed. So a large percentage, greater than 60% of those that were temporarily shut down stayed closed. Now, as far as new business applications and starts last year, it really ramped up in the third quarter. Fourth quarter, we saw it continue level out just a little bit, about 26% up from previous years when we look at 2020, so a big uptick. What does that really mean for the market? Well, when we evaluate small businesses for loan products, a lot of times for a small business loan, a lot of our clients are looking for a 2-year performance window to say, how has this business been operating for 2 years? Are they doing well? Are they repaying their debts? What's their credit history? As they evaluate. What we're going to see is a lot more businesses. We saw about 4.4 million business starts last year. Those businesses have a 2-year window here where a look at some non-traditional data along with core credit data and some of their consumer small business data is going to help us to evaluate and provide services and lending opportunities to them. We're going to see a lot of banks do that to be able to get out in front of this surge in new businesses that are coming into play, certainly in 2021 and 2022. So it'll be a big market available for growth and a lot of new opportunities there. And about, you know, when we look at past history, about 50% of new businesses that open survive, providing an additional look. And as we see this economic growth and some additional stimulus for a consumer and for small businesses, there's an opportunity for that percentage to increase. So staying ahead of it as we look forward into the next year is really important in how we, the lending community, interacts with small businesses and consumers going forward over the next year. So when we look at it and kind of wrap it up for the quarter, we are seeing that markets are reopening. When I look here in Texas, ours is 100% shoulder to shoulder. Bars and restaurants, no mask. Mask is optional. I would say that from what I've seen in areas around, and as we've traveled around a bit, about 75% of people are still wearing masks. So that's good. We could still, across the US, see some bumps in COVID. It's stayed pretty low over the past 2 weeks or so, but we have about a 2-week lag in the incubation of the virus. So we may see some uptick here, which may cause some slowdown a bit in certain regions. So be careful of that as we go forward. Delinquencies remain pretty stable. We're going to see an end of some of the stimulus in the early part of summer. Now that stimulus, when we think about these programs, fraudsters are really focused in on these programs. They're good targets for them to go after. Once we come out of these stimulus programs, if PPP ends in March, a lot of the focus that was on those small business stimulus programs by fraudsters will switch back to the traditional lenders. And so we'll see an uptick in some first-party fraud and third-party fraud on our commercial lending space. So we'll be really monitoring that as we go forward. And as we talk to collection activities, those pre-treatment strategies certainly are helping to keep the rolling into delinquency buckets and keep those charge-offs down as we go forward. So as we go into the next 30, 60 days, we're going to see a lot more of those pre-treatment strategies enacted across different industries. And it certainly should help us to smooth out some of those curves as we get into summer and prepare really for the untying of some of these programs that have been in place to this point. So we're really going to have some cautious optimism as we come into the summer. But again, we're looking for 6% growth in the economy. We're really feeling it. If you feel that positive energy that's here in the US, we continue to see it pick up, and we are certainly on track for some good growth this year. So excited about that as we move forward. So I'll close with that. Gary, do we have any questions or any questions coming in our chat box that we could address?
Yeah, actually, we did have a number of questions that came in throughout the course of the discussion today. Bruce had the first question. Do you see, let me grab the mouse control there, Brody, if you wouldn't mind.
Sure.
Yeah. It keeps going to Texas from Costa Mesa. Do you see a correlation with stimulus payments and increase in hard to fill job openings sentiment, i.e. people are being paid not to go back to work? That was from Bruce. And I think that was
Sure.
Christian.
Probably for me. Yeah. Yeah, it's a good question. And certainly there's a lot of discussion around the incentives that, say, unemployment insurance causes, or perverse incentives in some sense, right? If you're getting an unemployment check, you might not search for work as diligently as if you're not. So I think there is some truth to that, certainly in some markets. But at the same time, I also believe that a number of folks are either still fearful of infection, right? So they're in jobs that are highly exposed, right? And they're preferring to take that check and turn down offers until they're feeling more comfortable with the state of the virus itself. So again, it points to the need to really control COVID. You do have childcare issues for a number of folks, right? So that's also a weight on a number of families. So they may have to be selective or choosy when it comes to the reservation wage or finding a job that would allow them to also provide for their children. And then finally, I would say, in looking at the data, that there's some of the K-shaped recovery occurring here as well when it comes to small business hiring. So try to find a skilled tradesperson at the moment, a plumber, someone who can do any type of construction. Very, very difficult. So I think if you looked at specific industries, specific occupations, professionals, right, they're in high demand and quite scarce. And so I think it makes a lot of sense that small businesses would also have difficulty in hiring certain individuals that they're looking for. So I think we need to dig a little bit deeper. There's certainly some of this effect from the unemployment insurance programs that's going on, but I don't believe it's a major factor in terms of inability or difficulty in finding workers at the moment.
Excellent. Justin says that he is currently experiencing an all-time low in his delinquency rate, which he partially attributes to the reasons noted by Derek. Assuming there are no additional relief packages, how long do you believe the current level of government support will continue to boost small businesses, with the understanding that there are a lot of unknown variables to take into consideration? And I think maybe Derek on that one.
Yeah, that is a wonderful question for all small business lenders, but it seems like at the moment government support is going to be ending around the summer to autumn, so late summer, early autumn. How much of that long-tailed recovery that Chris talked about has kicked in by then, and so small businesses will be able to take advantage of, is the big unknown for small business credit. We aren't thinking that there's going to be too big of a bump, but there probably will be a slight uptick in what we've seen from current delinquency and charge-off rates, just because, as I noted, they're at all-time lows right now, and that is attributable to a lot of the programs that we've seen coming out of these stimulus measures. So we probably will return to something more normal, probably around that 1.5 to 1.6 level that I noted for moderate delinquencies. It doesn't look likely to go much past that, or it might even stay a little below that. But the 1.2% for moderate delinquencies and all-time low for charge-offs is not going to be sustained, obviously, forever, as those government programs expire towards the end of summer and early autumn.
Excellent.
Yeah, I'll agree with you there, Derek. I think we're going to see, as we look forward into the early summer, we're going to see those forbearance and moratorium, not only stimulus, but you're going to see some of these other programs start to end. Again, even with some extensions that are put out there for the PPP that could potentially push it from March to May, we're still going to see some of that come back on to our small business owners. You'll see foreclosure moratoriums in certain regions end. That's going to bring some challenges. Bankruptcies have really been pent up for the last year. We may see an outflow of those coming up pretty soon as well. So as the economy kind of kicks back up, we get the courts open back up a little bit more and allow some more of those through, we may see some more of those challenges. So I think, as we look forward to it, if there's a potential for a bump, it's going to be early summer that we'll start to see those delinquencies pick up. And that's really where that's not where it's going to spike. I think it'll start to gradually go up from that point as money starts to run out. But we're really being positive, as long as we don't have another COVID outbreak, we should see the velocity continue to carry us through the summer and into the fall.
Yes, David Schmidt had submitted a question. After the stimulus ends, do you expect an increase in small business failures, bankruptcies, and closures, as been the trend in other recessions? So I'm assuming you're answering in the affirmative, that we're going to see that kick up. Okay. A question on inflation. I think this is on the minds of everyone, right? What is your outlook on inflation through the end of 21? Assuming inflation increases, what will be the impact on small businesses?
Oh, it's a good one. I think we can all chip in here. So my view is that we will see transitory inflation, certainly. We're already seeing some evidence of that. So we have supply shortages, we have these supply chains that have been disrupted, right? So you have, certainly in the construction industry, you can see a lot of that, right? Lumber being a prime example. So certainly you're going to see price spikes in certain commodities that are going to carry through, at least in the immediate term, over the next few months, as we restart the economy in many ways. If I'm right about labor markets, picking up some steam, there will be some wage pressure that builds there as well. Although the caveat there is that 10 million jobs is quite a large hole to fill. So I do expect to see some inflation pick up, but I'm not expecting some type of hyperinflation or even excessive inflation. I think it's going to be a while before we really start to see those pressures build in the labor market in particular. So I would expect short term, yeah, you'll see prices going up. You're seeing gas prices go up already as I drive by the pump every day. So that's here certainly in the short term. But I also am expecting businesses to step back up. We're seeing oil companies coming back out, opening up fields that they had closed. And so we will see some of those inflationary pressures subside as well. So,
Derek, Brody,
yeah.
in on this one?
Brody, do you want to take it first and then I'll finish, or do you want me to go first?
No, as far as what Chris is saying, certainly with supply, that's going to make a big difference as we start spending a lot of the stimulus that's out there now. We're going to see small businesses, and in one of the charts that you showed earlier, we see that increase potentially in raising prices. And we're going to see that because a lot of folks will be coming to the same place to buy. And we'll see that a lot of that, those component pieces already, we're seeing that a lot of the components are at a shortage. And so we'll see gasoline prices increase early. We want to go green, but it takes a little while to go green.
Yeah.
As we go forward. So we'll see gas prices in the short term really take off as we're trying to pull out of our winter months. But then again, I'm expecting some a subside as everything opens back up and we get going and those energy plants kick back on. Certainly here in Texas, we'll see those prices go down and certainly some ebb and flow here as we get into the summer. Derek?
Yeah, so I agree with what both of you said, and I'll just add on to that as far as small business credit goes, I think a lot of small business borrowers are almost looking forward to inflation picking up just a little bit so that they can justify raising their prices, because especially over the last few years with the growth of e-commerce, which continued during COVID, it's been very hard for small businesses to justify raising their prices. So this inflation that people are talking about is giving them a little bit of a safety so that they can raise their prices a little bit, maybe increase their pay for some workers, continue paying their debt. I think it's going to be a boon for small business borrowers. Just a little bit of inflation. Just a little.
Just a touch.
Excellent discussion today, guys. Excellent presentations from all three of you, and thank you to everyone for tuning in today to this quarter's quarterly business credit review. For more information, of course, on Moody's Analytics, you can find that at moodysanalytics.com. And for more information on Experian, of course, you know where to find us, experian.com/B2B. We'll be back again with the Q1 Main Street report here in about another month. We'll see how things are shaping up for small business, and I want to thank everybody for taking time out, and everyone have a good day. Thank you and good day, everyone.